Hey guys, welcome back to another video. Today we're going to be talking about the basic commercial banking terms and definitions that you're going to use on the job when working in commercial banking or lending type jobs where you're providing loans to businesses. So this is a beginner's guide to the basic terms on the job. So this may be for people that are just entering the industry, interns, or maybe even people that are looking to freshen up on some of these terms. So just to look at the terms that we're going to talk about, we're going to look at amortization, term, balloon payments, interest rates, covenants, debt service coverage ratios, working capital ratios, a borrowing base, and loan to value. And each of these concepts, these are terms that are very frequently used on the job when you're talking to clients. So you want to be comfortable in understanding what they mean, but also how they relate to risk and structuring deals. So I'm not going to give you just the definition, but I'm also going to give you what it kind of means and how it relates to deals. So let's just jump right into it here. So amortization. So amortization is essentially paying down the loan. It's the process to amortize a loan means to pay it down. And so lenders define upfront what the amortization of the loan is, either in years or months. You're going to pay back $1 million over 5 years. Therefore, that's 1 million divided by 5, or 200,000 every year. Or I could look at the equivalent of 5 years as 5 times 12 months per year, or 60 months. And I could divide $1 million by 60 and say, the amortization on a monthly basis is $16,666. So amortization is really important because it relates to the risk level of the loan. So just think about it this way. If I'm really comfortable in lending to you, I know that you're a very stable borrower, not a lot is going to change. Naturally, I'm okay in leaving my money out and outstanding for a longer period of time. So therefore, my amortization may be longer. I don't need to get paid back as fast because I'm comfortable in dealing with you as a borrower, or maybe I have some security which protects me, and therefore I can leave my money outstanding over a longer period of time. Now, the opposite, if I don't trust you, or it's an unsecured loan, or I'm unsure about the future, you naturally want the amortization to be shorter, because I want to get paid back faster. I want to recoup the money that I put out there and get some interest for it, but I don't want to wait for my money too long. So when you look at amortization, it's the inverse relationship to risk. The higher the risk level, the shorter the amortization. The lower the risk level, the higher the amortization, simply because I'm willing to wait longer to get paid back because I'm comfortable in waiting that longer. So to look at an example, typically, and I'm just kind of giving you some rough ranges here, in the Canadian commercial lending space, like a commercial real estate property, valued at multi-million dollars, the amortization on that mortgage may be 25 years because the property's worth something. Typically, it increases over time, so there's some good security. On the opposite end, if it's an unsecured cash flow loan, Canadian banks usually amortize those cash flow loans that are unsecured at between 5 to 7 years, not 25, 5 to 7. And so you can see the difference in risk level. So how does amortization relate to term? So a lot of people get these terms mixed up. So term is the length of time of the loan agreement. So if I agree to give you money for 3 years, at the end of the 3 years, I need you to pay me back the loan so that the loan terminates. Whereas amortization is the agreed upon time in which, over the course of the term of the loan, that loan gets paid down. And the funny part is, term does not have to equal amortization. I can give you loan agreement for 3 years, but maybe again, I'm lending against a property. So the amortization would be 25 years, but the term of the loan, the term of the mortgage, would be only 3 years. So just as a general rule, term can equal amortization, or amortization can be greater than the term, but amortization would never be smaller than the term. I wouldn't want to amortize over 2 years and the term is 3, because by the end of the year 2, my loan is done, and then the loan agreement essentially is effectively null, right? So just to give you a good example here, so consider a $2 million term loan, okay? I'm amortizing that $2 million over 7 years. Therefore, I'm taking $2 million divided by 7, so every single year the loan gets paid down by $285,714. So that's the principal loan amortization pay down every single year. Now, if that term of the loan is 3 years, that means for the next 3 years, the loan gets amortized at a rate of 7 years, or $285K. So at the end of the 3 years, whatever the outstanding loan balance is what gets paid back in full at the end of that term. And that is what is referred to as the balloon payment. So whatever's outstanding, if it doesn't nil out and doesn't get fully paid down throughout the course of the term, then whatever outstanding amount is at the end of the loan is the balloon. So in this example, I'm paying down every year 285. The term is 3, so that's 3 full years of 285 or 857 142. So I deduct that from my initial starting loan balance of $2 million. And so at the end of the 3 years, I would have an outstanding loan balance of $1.142 million. And that is what the balloon payment is. And so, the question may be, well, why, why would a lender be comfortable in that? The business is not going to have $1.1 million in cash sitting around. Well, it's not, they don't really expect for you to pay back the balloon payment in full unless you obviously came into a lot of cash. Usually what ends up happening is that the loan gets refinanced. So you enter into another 3-year term to go down and keep paying down the loan. And the reason why lenders will keep the term of the loan shorter is that it gives them the opportunity to more frequently renegotiate the rate on the loan, the terms of the agreement in terms of covenants, and also it gives them the option to walk away. Say, for example, 3 years from now, the business's outlook, the industry changes a lot. Well, you may demand as a lender to say, you know what, I'm not open to refinancing this loan, so you better find another lender to step into my shoes and take over this balloon payment and do the refinancing. So that's why term is a way to effectively manage, your out as a lender. So the interest rate, naturally, everyone knows what the interest rate is. It's the cost of money that you're going to be paying for the loan amount that you're borrowing. But from a commercial lending perspective, I kind of want to focus in on some underlying principles that relate to the interest rate. And the first bullet point over here is that interest rates can be fixed or floating. And I typically see more floating rates nowadays simply because of the low rate environment. A lot of borrowers are not concerned about rates increasing as much. And so a lot of commercial borrowers are taking floating rate loans versus fixed rate loans. But if you wanted to enter into a fixed rate loan, typically a fixed rate loan is going to be higher than a floating rate loan. And the reason for that is that, the bank, the lender, is pricing in expected future increases in the interest rate. So if the market is forecasting in the next 5 years that interest rates are eventually going to creep back up, naturally the current floating rate is going to be a lot lower than where they forecast rates to be in 5 years' time. So if the bank is going to take the risk of fixing their current rate, they're going to increase the rate that they're offering you at a fixed level relative to the floating rate. And typically that premium may be 25 basis points, so 0.25%. It could be 0.5%. I've seen it even go up to about 1%, where, for a floating rate loan, it's 4%, but for a 5-year fixed rate loan, it may be 5 or 6%. Right? So that's the first concept I'd like to drive in on. The second one is, when does the interest rate payment come out? So for banks, it all depends. Like the bank that I worked for in Canada, we would always draw interest and calculate interest on the 15th of the month, mid-month. Some other lenders may do it at the month end, and some lenders may do it upfront on day one of the month. It all depends on the type of lender and their internal policies, but it's not standardized. So each and every lender is a little different in that regard. So you kind of want to understand and pay attention to, when does the payment actually come out? And funny enough, when I worked in the lending space, so many customers, when I would onboard them and bring them on as a new customer, they'd always ask, hey, when's the loan payment coming out? Oh, it's the 15th. Huh, weird. My last lender was at this or at this. So just something to know about. And so the general underlying concept of interest rates is that the interest rate reflects the risk level, and there's a direct correlation between it. So unlike the amortization where there's an inverse correlation, so if amortization increases, risk goes down, for interest rates, there's a positive direct correlation. So that means that if the risk level of the loan or the borrower is, high risk borrower, then the interest rate would be higher to reflect the higher risk level. And vice versa, if there's a lower risk level, so say, for example, you're lending against real estate, there's a really good loan to value, whatever the case is, then the interest rate would be lower simply to represent the lower risk level of that loan. And so the risk level of a loan changes over time. So what typically commercial lenders may do is they may change the rate as you pay down the loan. And the reason for that is, so day one, I've given you $1 million, and I look at your current profit and say, hi, I'm comfortable in giving you this rate at 6%. But say, for example, you take 5 years and start paying down that loan over 5 years and it amortizes. Well, all of a sudden, you now have a lower outstanding loan balance. The business continues to perform at the same level. How does risk change? Well, it goes down because you've paid down a certain amount of leverage. So what some lenders will do is that interest rates are not fixed on a loan. They change and decline or increase over time depending on the risk level of that borrower. So certain ways to do that is as the loan balance declines. So when you pay down 20%, 30%, or 40%, the interest rate drops by 0.5% or 0.25%. And then the opposite could happen. Maybe there is a change in the financial performance of the business. So if the profit level in day one was $1 million in profit and the business declines to $750,000 in profit, my profit level has declined. So the risk for me as a borrower has increased because I have less profit to service the loan, and therefore the interest rate would increase in that example. So there are different ways that lenders find ways to really either claw back some interest rate or give the borrower a bonus because they're doing better. And then the last thing is, for some loans, maybe the lender's a little bit more creative and they can decide to defer interest. So most cases, when you're paying down a loan, it's paid cash interest. On the 15th of the month, a payment comes out. You have your scheduled amortization payment in addition to the interest on the loan for that month. But maybe there are high growth companies that don't want to use their cash to service interest. So a way to do that is to defer it and pick it. So PIK, or paid in kind, is essentially taking the interest rate that would be charged to that borrower in that month, and instead of paying it in cash, you add it on to the outstanding loan balance of the loan, and so the loan increases over time and compounds. And so what that ultimately does is over time, the loan increases, the interest rate keeps compounding, delivering a higher return for the lender and achieving what the borrower wants, which is to save cash in the short term, but eventually when they're bigger and more successful, then pay down the loan when they're actually ready to do so. So some creative lenders will do that. I would say most banks are not comfortable in doing that. For example, the bank that I worked for, we would do that, but we would pick maybe a portion. So maybe there was an 8% interest loan. We would pick up to a maximum of 2%, but 6% would be cash interest that was non-negotiable. You had to pay it every month. So it depends on obviously the case-by-case situation. But you should be aware that especially when a borrower maybe says, whoa, that's such a high interest rate, I can't really pay that. Well, you can negotiate and saying, hey, maybe I'll give you 6% and then I'll pick 2% so that, that's not as painful for you in the short term. Now, covenant. In a way I look at it, is it's a promise from the borrower to the lender. And a covenant can be financial, it can be positive, and we'll talk about what positive means, or it can be a negative covenant. I promise to do something, or I promise not to do something, or financially, I promise to do X. So the way I look at covenant as a definition is it's a promise that I, as a borrower, am making to a lender. I contractually agree to do X. I contractually agree to continue to perform at Y, whatever the case is. And so let's talk about the three covenants. The most common that you're going to deal with in a day-to-day lending job is financial covenants. And these are the underlying financial measures that are used by lenders to evaluate the strength and the credit quality of a borrower. So when someone says, wow, they're really strong in terms of their covenants, that means that they're very strong relative to the financial promises that they made. So I promised I need to do X and I'm doing much better. And then the opposite would be the case. Oh, they've broken their covenants. They're underperforming their covenants, which essentially means that they haven't been able to deliver and therefore they're underperforming. And so whenever you analyze a deal and decide, is this a good deal or not in terms of performing and delivering on a loan, lenders consider the financial covenants as the central key decision, go, no go type decision. So if I'm a lender, the very first thing that I do is I ask for 3 years of financial statements from the client, the borrower, and then I will run those financial statements. And if they're seeking to borrow X, I will calculate the interest, the amortization relative to what they generate as profit on their financials, and I'll calculate their financial covenants. If they're clearing the financial covenants that we have in place, then good, we can continue the conversation. If they can't, either they have to lower their loan request or we just don't deal with them because they're not profitable enough. So the financial covenants are critical. This is what you're going to work with every single day. And so going back to here, a borrower must agree to maintain their performance within a certain threshold to remain compliant with the lender. So not only do you analyze the financial covenants up front when you decide to lend to a business, but financial covenants are essentially ongoing, measures of performance that you're going to track the business against. And so typically there are 3 common covenants that, a lender will focus on. The most common, and we'll talk about it, funny enough, in the next definition slide, is the debt service coverage ratio. And this essentially tracks the profit performance of the business. And typically lenders will look at a certain threshold in terms of it needs to be 1.2x or more, or 1.5x or more. And I'll go into the actual specifics of the calculation and what this all means in the next slide. So just bear with me. The next one is the leverage covenant. It's a situation where you would say, I'm giving you $1 million, your EBITDA or your profit is Y, I'm giving you X amount of dollars in leverage and in debt, and then you calculate debt over EBITDA, what is the leverage? The higher the leverage covenant, naturally, the more risk there is because you're giving them more money that they're borrowing. The lower the leverage covenant, obviously, the better. So you want a higher debt service coverage because you're generating more profit than you need to service the debt. And you typically prefer a lower leverage covenant because therefore there's lower risk in that deal. And then the last one is there could be a specific covenant around loan to value or leverage relative to the asset that is being lent against. So most lenders may deal with real estate or may deal with equipment. And so all of these assets that are being lent against have a sellable value, something that, in a worst case scenario, the lender would take control of that asset and sell it off. And so the term that is used for that is loan to value. So if I have $1 million property and the mortgage on that property is $750,000, then there's $750,000 against $1 million in value, or 75% of the value or loan to value is debt. And so typically lenders are going to keep track of the current value of assets that they've lent against relative to the leverage. And so as the leverage increases, the loan to value increases and the risk increases, similar to the leverage covenant. And if the loan to value decreases, that means that they're paying down the loan or the asset value has increased, and therefore the loan to value has declined. And so these are some of the financial covenants that you'll keep track. And so these are essentially performance-based measures keeping track of the quality of that loan. So when people say, how do you stay up to date with a loan? What you're doing is you're constantly checking the financial performance of the business against their financial covenants and tracking to see how it changes over time. Now, the remaining 2 covenants are non-financial typically, and they relate more to promises that relate to the day-to-day business. So a positive covenant means that the borrower must agree to something. The borrower shall have financial statements audited. The borrower will sell the property in 2 years' time. The borrower will make sure that there's $100,000 in cash at all times in their working capital cash account, whatever the case is. So whatever promise you're making, it's essentially a positive covenant when you're promising to do something. The vice versa of that is a negative, where the borrower agrees not to do something. And so typically, lenders don't want to see shareholders and the owners of the company take money out of the company without obviously seeing how much money is being taken out to make sure that they're not draining the cash accounts of the business. So most lenders will have a negative covenant that says you shall not pay yourself a dividend so long as this loan is outstanding without our permission. And so lenders are going to put in these types of rules around the loan agreement just to make sure that you stay in line. So don't pay a dividend. Don't pay yourself a salary above $200,000. Don't sell off these assets without our permission, blah, blah, blah. So those are negative covenants that the buyer's agreeing not to do. Okay? So let's jump into the financial covenant that we were talking about on the last slide, debt service coverage, or DSCR. I kind of use DSCR because that's what all the guys in the industry use. So DSCR is the most common financial covenant used by lenders to evaluate the financial performance of a company to meet its debt obligations. To debt service means to meet your debt obligations. And so this ratio, it can be simply described as the amount of cash flow, the profit that a business generates, divided by the amount of debt obligations required to service the loan within a year. So we look at DSCR within a 12-month period. And so whatever quarter you calculate your DSCR, you take the last 12 months of financial performance, because it wouldn't make sense to go back 24 months or 36 months because it's irrelevant. What you're trying to track is the ongoing annual performance of the business. And so you're going to look back at the last 12 months of profit and adjusted earnings and the last 12 months of required interest and debt payments. And so you'll take the profit divided by the required obligations, and that will give you your DSCR. So just to give you a sense of the profit and the above, so the numerator here. So the numerator is you start with the net income plus deferred taxes, which is essentially non-cash expense. These are taxes. This is really for accounting purposes, taxes that are deferred for the purposes of preparing your financial statement, but no cash actually exits the business. Therefore, you add that back. Same thing with depreciation. This is an This is essentially an accounting expense, but it's a non-cash expense to represent the decline in the asset value, the book value of the business's assets. So these are non-cash charges that are added back. And then the last thing is you also want to add back the interest on the debt, because remember, you don't want to kind of double count here where you don't want to exclude this because it's going to be a double whammy. You don't add back the interest, but then you calculate it in the denominator. So you take the profit of the business, you add back any non-cash charges, you add back the interest on the debt, and that gives you your available cash flow and profit used for servicing debt. And so then that's the sum, and then the denominator is the sum of interest and principal payments over the last 12 months. And so ideally, you want this number, the top number, to be higher than the bottom number. So really, when you look at that, you want it to be 10 and 9, not 9 and 10, because then it's below a 1x ratio, in which case it represents that it's below 1 and the business cannot service all of its debt obligations over the next 12 months. So looking at this bullet point here, lenders require a minimum level of debt service to qualify a borrower. And as I said, you don't want to be below 0 because then it shows that you can't service the loan. And typically, lenders, when they're qualifying a prospect, will not aim for 1-to-1, but rather 1.25 to 1 or 1.50 to 1. And that means that for every $1.50 in profit, there's $1 in debt servicing costs, which means that there's a buffer there. And so a lot of times I remember when I joined, I was like, well, why do you care? If I bring in a prospect that's a DSCR of 1x, I mean, technically they can pay their loan back, so why can't we lend to that 1x? And the reason why is lenders are naturally conservative. So they want to build in a buffer in addition to the 1x coverage to say, hey, this business is generating more than it needs today, and therefore, if there's a little hiccup, maybe a customer goes away or they lose a key account or they lose a key employee that generates some revenues, the business is not going to immediately default. So you don't want a borrower to be on the edge of default. You want to have a bit of a buffer there. And that's why some lenders, if they're ultra conservative, will target a 1.5x DSCR ratio, and others will target a 1.25 or 1.2x DSCR ratio. The lender that I work for example, in Canada, we targeted a 1.2 to 1.25x. Whereas I've heard other lenders that are a lot more conservative, they'll go to up to like 1.4. I haven't really seen lenders go to 1.5, but I've heard historically in the past they would do that. And so, there are other ways to modify DSCR. So this is not the be all end all formula. Each lender is going to have a different little approach to DSCR. And one of the key things that people aren't accounting for here is, in addition to your debt costs, there are required costs to operate the business, which I always refer to as CapEx. Capital expenditures are essentially expenses on an annual basis that you need to make in order to sustain the business's asset base. If I need equipment to generate my cash and my revenues, but my equipment starts getting old, I need to replace that equipment. That's a non-negotiable expense. Eventually, I'm going to have to replace my equipment. So there's a certain level of CapEx that annually each and every business has to invest in their business to continue that stream of income, that stream of profit. Some businesses have very low CapEx requirements, others are very high. Like an equipment rental business has to churn their fleet very frequently. So some lenders will take that as a financing cost, and they'll take CapEx and put it as the denominator here. So in addition to interest and principal, they'll also tag on CapEx so that you're looking at your profit, your cash flow, divided by your non-negotiable expenses, the debt obligations plus the CapEx. So sometimes that's how the formula will change, but this is the more simple formula. Now, the working capital ratio is a financial covenant that tracks the liquidity of the business. So the DSCR tracks the financial profitability, whereas the working capital ratio tracks the liquidity. So one focuses on the income statement, the other focuses on the balance sheet, and both are typically used in a loan. So you don't see one or the other, you see typically both, because each financial covenant focuses on a different set of financial statements, okay? And, as the rule says, cash is king. So cash is really important from a lender's point of view, because you want to make sure that whatever the business is selling, in most instances, business will have accounts receivable, meaning that they will allow the customer to take the product or service off their hands to complete the sale, but pay them 30 days later or 45 days later. Now, lenders are worried about, okay, you've made the sale, so technically you've booked a sale, you've sold $1, but you haven't collected on that dollar yet. So I want to see sales converting to actual cash. And so that's really important. And that's why lenders will look at the balance sheet to determine, well, is your AR naturally just skyrocketing and shooting up because you're never collecting on it? Or is AR fairly steady because you're always selling, but you're also collecting on the older AR, and so it's kind of plateauing and staying at the same level? So that's why lenders will look at the balance sheet. And so the working capital ratio is quite simply the current assets of the business, so cash, inventory, accounts receivable, prepaid expenses, any other kind of types of current assets, divided by the current liabilities, accounts payable, accrued liabilities, tax obligations, HST, GST, whatever the case is, right? Current liabilities plus the long-term portion of that debt, the current portion of that long-term debt. And so what that means is essentially in the next 12 months, if I am required to do $100,000 in amortization on my loan to pay $100,000 at a minimum, therefore that is the current portion of the next 12 months of my debt. And so by adding that to the current liabilities, you're essentially testing to see, is there enough current assets, stuff that's mine, that I own, that is coming in as cash inflows? Is that servicing? Is that enough to cover the outflows, the current liabilities, plus the $100,000 in required debt principal pay down for the next 12 months? And so typically lenders will target 1 and above for a working capital ratio. Usually, I would say for my bank, it was about 1.1x. Sometimes it'll be 1.2x, but for other more capital intensive businesses, lenders may even go down and saying, hey, so long as you maintain at 1.1, 1.0, that's all we care about. But this is another way to kind of test the strength of the business to say, is there enough liquidity, cash on the balance sheet to really see the strength of the business? Now, this last point here, so why is like a 0.9 or a 0.8 working capital ratio a bad thing if the DSCR is 1.25? And remember, I go back to the collection. So there's a huge disconnect between the income statement and the balance sheet, because you can report $1 of earnings on the income statement and say, hey, I've generated $1 of profit. but the balance sheet reflects whether you actually collected on that invoiced account receivable and therefore actually collected on that dollar of profit. So that's why lenders always use both. And so there are some extreme situations where the DSCR may actually be positive and maybe above the required covenant, but the working capital ratio is in breach simply because, again, the business is not collecting on equipment on accounts receivable. Now, the borrowing base. So borrowing base is a term used largely around the operating line or the op line for a business. So most big banks offer businesses an operating line, and this is essentially a revolving, so it goes up and down day to day, short-term loan to help finance the day-to-day expenses of a business. And so essentially what an operating line does is, again, going back to that account receivable, if I've sold $1 and I've collected $1 in accounts receivable, that money may not come in that cash may not come in for another 30 days. But I may have other expenses that I need to pay for before those 30 days when I actually collect on that sale. So what I do is I take that account receivable, I go to the bank, they lend against it. The account receivable is the borrowing base. They lend against it, and therefore I can get a certain amount of cash advance against that account receivable to finance my interim expenses. When the amount comes in 30 days after, I pay down my operating line and I'll have a little extra as well as my profit. So essentially an operating line is almost like a cash advance on your current non-cash assets, inventory, accounts receivable, any types of prepaid expenses and all that kind of stuff. So, sorry, not prepaid expenses. It's only inventory and accounts receivable. So, by taking those current assets and financing them, you're going to get an advance of cash to allow you to run the business until you actually can liquidate and actually sell that inventory or collect on that accounts receivable. So lenders will often refer to a business's borrowing base as the amount of the total current assets readily available to be financed by an op line. So the accounts receivable and the inventory are the borrowing base. That's what we mean when we say borrowing base. And so an operating line is made available up to the margining base or the borrowing base available to the business based on this non-cash liquidity. And so the formula is, I, as a lender, am going to give you an X amount of percentage against your accounts receivable, X amount of percentage against your inventory, less obviously your current. That's supposed to be current liabilities, not current receivables. So that's wrong. So less, 100% of my current liabilities. And so whatever the net value is, that's ultimately what the borrowing base is. So typically lenders will advance between 70 to 90% against accounts receivable, between 40 to 60% against inventory, and they'll take 100%, just to be conservative, of accounts payable, and then sum them all up, and that is really what the borrowing base is. Now, insurance against accounts receivable or inventory will increase the loan amount. So the reason why a lender won't give you 100% against your accounts receivable is that they also need to make a certain amount of money and factor in a certain level of risk. So the higher the risk of collection, so if I don't really expect to collect those accounts receivable, the lender will probably not advance much against it, maybe 70%. But if these are highly collectible accounts, it's a government customer, or I have insurance, I've insured my accounts receivable for international customers, the bank is going to say, well, it's highly likely that they're going to collect on that account receivable. Therefore, I may advance 90% against that. So if I have 100,000, they'll give me up to $90,000 against the accounts receivable. Same thing with inventory. Inventory is a little bit more illiquid, right? Because I have to sell it. I have to maybe process it and then sell it. So there's a little bit more work than just collecting on an account receivable. So that's why the advance is a little lower. But same thing, if I have inventory insurance, or I have some form of protection to make sure that I can liquidate my inventory more quickly, they'll advance more, maybe 60%. But if it's old stock or retail apparel, clothing that it's slow moving, it's going to take a very long time to sell, then they may only advance 30 or 40% loan to value against the inventory value. Okay, so those are the kind of the thinking behind the borrowing base. But ultimately, it's taking your accounts receivable plus your inventory minus your accounts current liabilities, and that is the sum of the borrowing base for the business. Now, we kind of already talked about loan to value, so I'm not going to talk a lot about it, but ultimately, it's the most common term that you're going to use when you talk about the loan relative to the underlying asset that is being lent against. So, for example, property is worth $1 million and it has a $750,000 mortgage or loan against the property. The loan to value for that is $750,000 divided by a million, or 75%. So the higher the loan to value, the higher the risk, and therefore the higher the interest rate charged on the loan. We kind of talked about this before. Vice versa, the lower the loan to value, the lower the risk, and therefore, typically the lower the interest rate is as well. So loan to value changes relative to the type of asset that is being lent against. So for real estate, because it's such a strong asset, typically historically increases in value, loan to values are a lot higher. So for example, your home, residential real estate, you'll see loan to values go from 80% up to 95%, right? Loan to value. So, in Canada here, we have like 5% down type mortgage lenders, but obviously they're going to charge a higher interest rate for those types of borrowers versus if you have 20% down, you don't need to pay for mortgage insurance, and as well, the bank is going to give you a much cheaper mortgage. So loan to value again and how that relates to interest. Now, say for example, equipment. Equipment, funny enough, sometimes for larger pieces of equipment, the bank is going to provide a lower amount of loan to value, whereas with smaller pieces of one-off equipment, the bank is not going to try to grab everything and try to write it down. So they might just give you 100% financing against it. It all depends on the type of piece of equipment. But what we typically see in Canada is that loan to value for pieces of equipment will range from 75% up to 100%. Now, for commercial real estate, it's a little bit less readily available than residential real estate. There's typically less buyers of it relative to residential real estate, and therefore the banks will build in a buffer of the loan to value, of the maximum loan to value that they're willing to give on that real estate. So especially for an investment property where you're not occupying that real estate, the loan to value for a commercial property may range from 75% to 85%. The reason why is you're not in the property, you're leasing it out to someone else. So, you may not have as much of an incentive to see that mortgage through and make sure that you're meeting your obligations. So banks for IPLs or investment property lending will range in loan to value from 75 to 85. Now, this differs from commercial real estate where you are the sole tenant or the majority tenant, because that is an owner-occupied real estate or a real estate deal. Your business is operating out of that facility. So it would not be in your interest to stop paying that mortgage and meeting those obligations. So banks, when they see owner-occupied real estate, they know that that borrower is going to be a lot more cognizant of meeting the obligations, and therefore, they're willing to loan more. So some banks are ultra conservative and will stay in that 75 to 85% range for both IPLs, investment properties, and owner occupied. But my bank, the one that I used to work for, we would go up to 100% loan to value for owner-occupied real estate and do maybe 80% loan to value for investment properties. So I may even do a separate video on kind of owner-occupied versus IPLs, but ultimately the difference is that on investment property, you're more likely to walk away because it's an investment, whereas if you operate out of that location day to day, your business is tied to that facility, and therefore you're less likely to default on that mortgage. So some lenders are willing to give you up to 100% loan to value on that owner-occupied real estate. Okay, so hopefully that kind of explains it. So that's the first video for these kind of terms and definitions. I have a part 2 coming up as well, so make sure to check out the channel. If you have any questions or you kind of want to talk about these concepts, please comment below or reach out to me over LinkedIn. And obviously, if you have any other kind of terms or definitions that you're looking to, seek some clarification on or want me to cover on the channel, then same thing, please comment below, and hopefully I can make a video in the future about that. But outside of that, hopefully you found the video helpful, and have a great day, guys. Thank you.